Soros's trading philosophy was built around the so-called reflexivity theory. He described this philosophy quite well in his book, The Alchemy of Finance. And in this video, let's briefly talk about it. One of the defining characteristics of human psychology is that people often perceive the world not as it truly is, but as they would like it to be. Instead of relying solely on an objective assessment of reality, people interpret events through the prism of their own preferences, desires, and emotions. As a result, their perception of reality can be distorted. In some cases, people evaluate events more optimistically than they really are. In others, more pessimistically. And then, making decisions based on such a distorted perception of reality, they can make erroneous decisions that ultimately affect and change reality itself. This psychological tendency, when subjective perceptions affect decisions, and these decisions in turn change the perceived environment, is the basis of the theory of reflexivity. In his book, Soros explains how this theory works in different markets. In the stock market, it works like this. Stock prices depend not only on actual fundamentals, such as revenue or profit, but also on expectations about what those fundamentals might be in the future. For example, in the case of new technologies, the investor expects that these new technologies will displace the old ones, just as smartphones replaced push-button mobile phones. In turn, this will lead to an increase in the market share captured by the new technology and, as a result, to an increase in the company's revenues and profits. And if such an expectation is formed in the conditions of an existing hype among the vast majority of investors, then this in turn can lead to an increase in the popularity of shares, which will provoke additional demand and which will lead to a premature increase in share prices. In the sense that share prices will grow long before the growth of fundamentals occurs. And each individual investor will be ready to buy shares at inflated prices, expecting that in the future, these prices will be justified by the real successes of the company through business expansion or the creation of a new product line, which will increase the company's revenues and profits. The only problem is that such individual rationality can provoke collective irrationality. If a person is in a building where a fire has broken out, then the best rational way out for him will be to leave this building as soon as possible. When a fire breaks out in a crowded place, a stadium or a movie theater, such individual rationality can lead to a stampede as everyone rushes to the exit. The same is true in the stock market. Against the background of the popularity of the company itself, a completely irrational bubble can form, where the share price will grow to an inadequate level, even despite the future prospects of the company itself. As an example, we can recall the hype surrounding Tesla shares, and how in just a few years the company's share price increased almost 30 times, and how, as a result of this hype, Tesla became the largest car manufacturer in the world by market capitalization. And the most interesting thing about this stock rally was that the actual fundamentals were growing more slowly than the stock price. This meant that investors were willing to overpay for the shares in the hope that the company would achieve higher sales, profits, and perhaps become the new world leader in auto production in the future. The only problem was that in their pursuit of Tesla shares, they drove up the share price to such a level that the price lost any rational explanation. And Soros writes in his book that such a significant discrepancy between the share price and the fundamental factors can persist for some time. As long as investors believe that the company is able to justify the high credit of trust that it has received. However, as soon as the fundamental factors in the future for some reason are lower than investors' expectations, this can lead to a collapse in share prices. In the example of Tesla in recent years, this trend has been very clearly visible. Despite the fact that the company has significantly increased revenues and profits over the past few years, this has not affected share prices in any way. And all because the hysteria around the company's shares has driven the price to an inadequate level, and the company has not yet justified the high credit of trust that is embedded in the share price. But again, I use Tesla shares only as an example to explain how the theory of reflexivity works in the stock market. This theory works in a similar way in other markets. And although Soros himself admitted that understanding this theory did not always guarantee profit, and even led to losses, mainly because the market can remain irrational much longer than expected. Nevertheless, thanks to this philosophy, Soros became the famous investor we know him as today.